As compared to the past, in 2008-2009, resources were both larger in magnitude, substantial amounts. Mexico got a flexible credit line of $47 billion. Colombia got a flexible credit line of about $10 billion. And it was clear that if Brazil had requested one, they did not, they would have gotten a very large flexible credit line. So, number one, there was much more money. Number two, it was very fast. Number three, very importantly, it was preventive. These resources were put on the table before anything happened. And number four, it was unconditional. There were no negotiations, there was no back and forth, maybe yes, maybe no, there was not a lot of uncertainty. If you think about Mexico, for instance, if you add up the money from the flexible credit line from the IMF, you really can't add them directly, but just to make rough numbers, plus the swap lines from the Fed, they got about $80 billion of additional resources in a matter of months, which actually doubled the reserves that the country had. And this allowed the country to actually go through a crisis, and the same can be said for Colombia, and the same could have been said for countries that actually didn't need it. So the key point that I want to make here is that fundamentals clearly helped to have Latin America perform much better in this crisis than in the past, but they don't tell the full story. The other part of the story, and this is where I now go to my remarks when I touch on architecture, is that the response of the international financial community was very different, was much larger, faster, preventive, unconditional, and swift. And in our view, that made a big difference. So now the question, what does this imply for international financial architecture? And what does this imply for international financial looking forward? Well, you might argue, look, maybe the Americans felt so bad for the mess they had created, and they got so scared as to the size of the mess that was being created worldwide, that's why the Federal Reserve took this, this never-done-before step of putting these swap lines there, and the IMF also created the new instrument of the flexible credit lines. But the question is, what if the next crisis is not originating in the United States, and what if in the next crisis there's not such a swift response as there was in the previous crisis? Contagion was prevented in this case because the ad hoc nature of the response was the appropriate response, but clearly the international community cannot rely on ad hoc responses on whether the crisis is going to be originated in a large country that induces kind of a guilt sense and therefore a very swift response, or it doesn't. What is required is a much stronger institutional and certain framework such that the role of international lender of last resort, which actually played a major role in the previous crisis in helping Latin America, and I would guess other countries in the world, to avoid contagion and to more or less go by the crisis together with their stronger fundamentals, that response be institutionalized in a much stronger way. So at the Inter-American Development Bank, we're thinking that potentially what we need to think about is kind of a grand pact a la Maastricht in which developing countries make with the international financial community, so that the insurance role that Francois was talking about can be performed in a much more solid and certain way. This pact would have ex-ante eligibility to countries, to large amounts of support. Of course, to avoid moral hazard, you would have to condition this on good policies and good policy frameworks and sustainable frameworks, like having fiscal rules, flexible exchange rates, independent central banks. But the important point is that when a crisis occurred, regardless of the origin, whether it was originated in the United States or in somewhere else, resources would be there, everybody would know that they would be there, they would be swift, they would be automatic, they would be non-discretionary, they would be timely, and they would be large. And the combination of an incentive-compatible contract between countries induced to have good policies for eligibility, together with the sort of very large certain insurance response, could provide a framework of much greater stability that takes the best lesson from 2008-2009, which says that a combination of good, strong fundamentals plus a very solid international response allows the region to go through shocks of very large magnitude like the ones we did before. So it's a major change, point number one, in the way the IMF functions. The IMF needs to change to be an institution that plays a much larger insurance role with much certain rules, with much more certainty, and with larger resources. Francois mentioned it, but this is an important point. think if it was an insurance company that provides houses with fire insurance, and there's a fire in a house, and the insurance company says, well, let me think whether I'm actually going to pay for this policy or not pay for the policy. You know, let me inquire carefully whether this should be done or this should be done. You can't have insurance of that nature. So this would require deep governance changes in the IMF, which can then induce changes in the behavior of countries, because ex-ante eligibility would only be restricted to the subset of countries that are promoting good policies. And this would also take away the discretion of the IMF board to actually put those resources, because it would have to be automatic, and this would be very timely. That's point number one. Point number two would then, this would then induce changes in the other MDBs, both the World Bank, the African, the Asian, and the IDB, because to the extent that now you have a well-constructed counter-cyclical mechanism at the role of the world, with a very strong role of lender of last resort, you can then refocus the MDBs in their core development goals and take away the temptation, which occurs sometimes, of using MDBs to play in counter-cyclical role or to playing a behind-the-door substitute for the IMF, and the effectiveness of MDBs in development issues would then really be there. And the third point, and here I close, are the sort of issues that Padma was talking about. You can't go without further regulatory changes in the international private sector to ensure that the sort of risk-taking that was taken there before and the huge leveraging that was there before doesn't go on. But the combination of the strong fundamentals that are there and need to be pursued, plus these changes in international financial architecture, this role for the IMF of a large, non-discretionary, automatic insurance agency that provides insurance in incentive compatible ways to countries that have good fundamentals, plus the regulatory changes in the private international sector, should hopefully provide for Latin America a framework of stability. Latin America's main problem, and I'll end here, are not in the macro area. The main challenges for the region have to do with productivity, poverty, and income distribution. But these challenges cannot be solved in a context of macro instability. So these changes in the international financial community will be most welcome for the region. Thank you.
Thank you very much. So thank you very much, Santiago. I invite now Alan Taylor, who is the professor of economics in the Department of Economics and at UC Davis, and he's also the director of the Center for the Evolution of the Global Economy at UC Davis. Alan, the floor.
Thank you very much, Jerry. It's an honor and a pleasure to be here. I'd like to make some remarks under three headings. First, looking back before the crisis, what were we thinking? And I mean that in both literally and in other ways. Then what happened during the crisis to alter our thinking, and where do we stand today going forwards? So I want to focus on a couple of things in terms of what were we thinking, and I'm speaking here as an international macroeconomist, what were we thinking before the crisis? I think the first thing that strikes me looking back is that we thought that financial instability was something that only happened really at the periphery. It didn't happen in core economies. It happened to them, not us, not people like us. It happened to other people, the other. Right? And they had crises, single, twin, triple, they had sudden stops, but those kinds of problems were somehow solved in the rich, advanced countries. And of course, that has been exposed as a very complacent view, but I think more importantly, a view that ignored history and evidence. And even if you look back a decade or so, or two, in the advanced countries, one could have found evidence of significant financial crises, sometimes related to housing and mortgage busts and housing bubbles, sometimes related to banking collapses and so forth. But those have been forgotten. And then if one had been prepared to look a little more deeply into financial history, and Padma mentioned the distinguished Charlie Kindleberger a moment ago, people had forgotten a deeper history running back to the first era of globalization over 100 years ago, which was also an era of endemic financial crises. But I think we thought, well, that was then, and it doesn't happen anymore, and it doesn't happen to us here in the rich, advanced countries because we're so clever and advanced. So I thought that was a remarkable piece of complacency all things considered. And it was kind of a this time is different view, to borrow the title of the book by Carmen Reinhardt and Ken Rogoff, which has gone over a great deal of this ground.